All right, good evening, everybody. Can somebody just give me a thumbs up or something to let me know that you can hear me? Ah, perfect. Thank you very much, James. All right, we continue our magical journey about how things are valued. Um, we've now gone through how to look at bonds. We've looked at cash flows that come to us in different ways and sorts and figured out how we can figure out what the net value is of an investment. If we pay out cash today, then we have to figure out what all the inflows that we get off of that investment are also worth today. Then we can compare today against today, and we've got actually something that we can look at intelligently. We could theoretically, sorry, I'm just reading a question here. Uh, is there a document regarding the assignment which outlines guidelines and requirements is what we need to present in that? Yes, and I will present them to you. It's going to be you are picking a company. Um, we'll go with an American company. You have to go onto their website and download their financial statements, and then you're going to have to do financial statement analysis of that company. I'll be more specific in what I'm looking for, but that gives you an idea. My recommendation, don't pick a massive conglomerate. The more complicated the balance sheet and income statement, the harder it is to do the financial statement analysis. So be wise and pick a simpler company. But more on that later. So yes, I will get to that, and I promise that way before it's due, I'm going to give you lots of time and lots of knowledge of what you need to look for. So the quiz today is open now until midnight tomorrow. I didn't open it until noon today, so I'm giving you an extra day to do the quiz. It's still 15 questions. It is 2 hours long. So get yourself time in which you can sit down and answer the questions logically. Please try to do it on your own. Obviously, there's no way for me to check it, but please try to do it on your own. All right. Today, we're now moving forward into a financial statement analysis and looking at companies and trying to figure out what their financial statements are telling us. Um, we know from accounting that financial statements, particularly the balance sheet, are a snapshot in time. This is where we stand right now, or as of this date. The income statement is more of a video between times. So between the end of that month and the start of this month, this is what we did from an income perspective. So we have different ways of looking at um, the performance of a company. Sorry, there's a bug floating around me. Um, but sometimes the comparison is tough, and we're going to look at that today. So if we're ready, let's go. We have our land acknowledgement. We are land stewarded by the Anishinaabe, Haudenosaunee, and Wendat nations. We acknowledge Treaty 13, the Toronto Purchase, signed with the Mississaugas, the Credit First Nation, the Williams Treaty. We are looking after this land until we have to give it back. We will shepherd it and steward it accordingly. So today we're looking at Chapter 3, Financial Statement and Financial Models. We're going to look specifically at financial statement analysis. When we pull apart a balance sheet and an income statement, what are we looking for? Um, that'll lead us, after asking a hard question, into ratio analysis, because ratios work arguably better than dollars, but I'll show you why in a minute. From there, we're going to go to the DuPont identity, and the DuPont identity is actually based off of DuPont um, and analysis conducted on DuPont, and some of the interesting stuff that was uh, derived from those financial statements. Then we'll look at some models. Part of those models are going to say when we conduct a pro forma look at the future, for example, sales are going to grow 20%. So what? Well, sales and costs, we're going to assume have the same ratio going forward. So now we know what the costs are going to be. So we know what the uh, margin is. From the margin, we can figure out what the tax rate is, and then the tax rate, and then the post tax. And then we can figure out what's going to dividends and what's going to retained earnings. And that lets us build our future or pro forma balance sheet and income statement. And from that, we can determine whether or not we need external funding. And if we do need external funding, how do we calculate what we need? And if we don't wish to have external funding, what's the maximum we can grow without it? So there's going to be some good questions that we ask. And then there's some caveats afterwards regarding financial planning models. And there's always caveats, and we'll go there. Just a word of administration. Um, some of the questions on the quiz require manual intervention on my part. I have a wedding tomorrow and a funeral on Monday, so I'm probably not going to get to this until Monday night or Tuesday, just to let you know, to measure your um, be expectations. Thank you. Sorry, it's Friday. All right, financial statement analysis. When we looked at certain companies on January 22nd, 2024, we had price earnings ratios pretty much all over the board. I mean, Home Depot 23 to 1. So they were trading at 23 times what their earnings was. Citigroup 13 times, Microsoft 38 times, Amazon 81 times. So there's no one number. They do tend to clump together in terms of industries. So I would expect a lot of the banks to be closer to where Citibank is. Um, the tech companies, obviously, they're going to trade at a very high earnings anyway. But Microsoft is legacy, Amazon is new. So new is obviously trading more than or at a higher multiple than legacy is. And then we have two companies that had no PE reported because they had negative earnings. AT&T and Boeing both lost money in 2024. You can't have a negative price earnings ratio. We're not going to, well, you can, but we're not going to report a negative price earnings ratio. So where do we go? Financial statements. It's not like we have a user's manual here. I wish we did, but we don't really have a user manual. We're going to try to create one as best as we can, but there's no one answer to all the questions. The goal now is to understand why we have financial statements, how we use them, and a word of caution because they can be abused as well. So we're going to learn about that as well. Not so that we can do it, so that we can spot it. Why do we have financial statements? We have financial statements so in an unbiased fashion, we can report what's happening to a company to outside people. Who uses financial statements? Internal and external, right? Internal, who is working for the company. External, generally speaking, who do we owe money to? Those people have an interest in knowing that they're going to get paid back. And we use financial statements to communicate the financial information of how we are doing to our counterparties. Now, the problem is financial statements aren't created to answer questions. Financial statements are created to give you a picture of where we stand. To answer the questions, we have to know to ask the questions. So, what we're going to learn today is how to ask some of those questions and how to interpret some of those results. One of the key things that we have seen in the last 50 years in financial statements is standardization. We try to get financial statements of different companies in the same industries to look the same. That way we can hold them up and have apples against apples instead of apples against oranges. Now, we still do have problems because what happens if I open up the financial statements for Royal Bank of Canada, I open up the financial statements for Citigroup, and open up the financial statements for Mitsui Bank in Japan. Royal Banks is in Canadian dollars. Citigroup is in US dollars. Mitsui Bank is in yen. How do we compare these? So we still have some issues here, right? And what happens if I look at Citigroup or HSBC that has a balance sheet that's $1 trillion and try to compare that to a small US regional bank? The size is a problem. I can say Citibank has or HSBC has earnings of $10 billion. And um, Oceans Bank in Florida has earnings of $1 million. How do those compare to each other? You don't know until you can compare those earnings against the assets that generated those earnings. So if Oceans Bank generates $1 million with assets of, I don't know, say $1 billion, and HSBC generates $10 billion with assets of $1 trillion, how do those match up? And that's one of the problems we have with financial statements. Um, Size is a problem, and the currencies are a problem. Uh, HSBC against Well, HSBC is a problem too because it's a global bank and it's headquartered out of London, so its financial statements are going to be in pounds. Um, how do I compare pounds against yen against dollars? So that's a problem. What we have found is that if we can try to common size things, then it's a little bit easier to look at. Um, if we try to bring everything to percentages instead of dollars or yen or pounds or whatever, and we say net income for HSBC is 6%, and net income for Mitsui Bank is 10%, and Royal Bank of Canada is 8%. Now we can compare those in a logical way. And say one is actually generating significantly higher returns than the other is. Um, that's the use of common size financial statements. And to make common size financial statements, the one on the left is our balance sheet. Pretty standard balance sheet for Proofrock Corporation. We're going to use Proofrock for a little while here. For the years 2024 and 2025. We're looking balance sheet right now. We've got assets, current assets, etc. Total assets in 2024, $3.373 billion. And in 2025, $3.588 billion. Liabilities and equities the same. Um, the breakdown we're interested in, and we can get the breakdown by doing our common size. A common size says we have total assets of 3.373 and 3.588. We'll make those equal to 100. And then moving up the balance sheet, what do each component of the total make up for the total? So cash is 2.5%. It goes up slightly to 2.7%. That's 84 to 98. Accounts receivable, 165 to 188, went from 4.9% to 5.2%. We're still around the 2.5 area. We're still around the 4.5, 4.95 area. So I'm going to say these numbers aren't changing dramatically. Then when we look at from a composition perspective, total current assets is 19%. It goes up to 19.7%. Still not really dramatic changes, but this gives us the chance to look at numbers, take the dollar, the mystification of the dollar amounts out, and then look just at the percentages and say, how have the percentages changed? And now we can go back to other balance sheets for other companies that may have, they may not be $3 billion in assets, they may be $300 billion in assets. But the percentage that we're looking at on the common size balance sheets gives us exactly the same information for each one. So that's why we look at common size balance sheets. Um, the totals have to be 100%. So when we go back here, the totals are 100%, right? There's going to be rounding in here. So when we do all the rounding, and try to add them all up, they may not add up to 100%. That's not the point of the exercise. The point of the exercise is to say, about 80% of our total assets are fixed assets. About 19% of our total assets are current assets. That's kind of the game we're trying to play here. Um, when we look at the last balance sheet, debt as a percent of total assets has increased. So where was debt? Long-term debt was 15.7. Where do we go? Yeah, we can't do total debt here. Well, we can do total debt over here. We still can't anyway. But we can see how the composition of long-term debt from 531 to 457 has gone from 15.7% to 12.7%. It has improved. It is looking better. How's our short-term stuff looking? We're going to dig into that and see if we can come up with a better answer than what we have right here. So that's our common size balance sheet. Now, there are temptations that we can pull out of this, but it's better to put those aside for the time being and then say, what are we really trying to compare? And rather than just pulling out a hodgepodge and saying, I see what the percentages have done and they're kind of moving in the right direction. We're pretty happy. Do not invest money based on that. Don't do more analysis. And that's what we're going to do now. Specifically, what are we looking at? Measurements of earnings, net income. What is net income? It's revenue minus all expenses, sometimes called the bottom line. Very important to realize that net income tells us a couple of stories. It tells us that there could be a difference in the firm's capital structures. There could be a difference in their tax structures. There could be a difference in how they record and generate income. So net income is important. Earnings per share is net income divided by shares outstanding. So now we say, okay, fine. If I am an investor and I buy some of your stock, how much of your net income belongs to me? You're generating net income of, I don't know, say in HSBC's case, $10 billion a year. If I've got stock in HSBC, what percentage of that's mine? It's important to know. That's why we buy stuff to invest in. We buy it so we know how much we can earn. We have EBIT, which is earnings before interest and taxes. It's called operating income, and it's the income before any unusual items. So what we're doing is we're putting back interest and taxes because we can't really control those anyway. So if we're looking at how we um, rate people that work for us or how we rate performance, we want to rate performance based on what you can actually impact. If you can't impact it, it's not really that fair for me to use that in your um, performance evaluation. It'll be done anyway, but it's not fair. And then we look at EBITDA, which is EBIT plus depreciation and amortization. Now we've added back all of the non-cash items. Now we can say this is the pure cash flow we're dealing with. We've taken out everything that we don't care about. Now this is exactly what I want to look at. So when we look at our income statement, we're going to have the same sort of a thing happening. We know that income statements are not snapshots in time. Income statements are what's happened from the beginning of this time period to the end of this time period. Where have we had sales? When we have cost of goods sold and depreciation, what's our EBIT after that? If we have interest, then we have taxable income. What percentage of taxes do we have? Remember, a corporate tax rate in the US is 21%. If you're not a corporation and you're a private company, you may well have a tax rate higher than 21%, which is one of the motivating factors for actually becoming a corporation. And then after taxes are paid, we have net income. What do we do with net income? We have choices. Net income is the money that's left over after we run our business. We can either give it back to shareholders, that's called a dividend, or we can reinvest it back into the company as retained earnings. So we have choices here, and companies are going to have a policy statement that says if we have net income, X% of that net income is going to be paid out as dividends. Whatever is not paid out as dividends is called the plowback amount, and that's the amount that we put back into the company. So if dividends are 20%, plowback's 80%. We can common size our income statement as well. When we look at, and normally when we do a common size income statement, we're going to look at one thing, and it's usually sales. Because sales is why we run our company. So if we have sales and say it's 100%, let's break down how we use that 100% of sales. 62% of our 100% of sales is the cost of goods sold. Depreciation chews up another 12%. That leaves us with 26% before income and taxes. We have interest that we have to pay out of 6.1%, and that leaves us with just under 20%. Tax rate of 21% takes out 4.2, leaves us with 17.7%. That 17.7% now has to get split into dividends and the addition of retained earnings. So now we're starting to see what the motivation behind our income statement and our balance sheet. But we still have a problem because, in as much as common size income statements and balance sheets are useful, it's still not really an ideal way to compare different sized companies and companies that have different elements to it. Like I said, pick a company that's not a conglomerate for the assignment that's coming up, because conglomerates are messy and pulling them apart is hard, especially if it's somebody like HSBC that has about 100 different balance sheets involved, and 100 different currencies. And if you want to try to do some analysis on that, it is painful. So don't. Pick something easier, I beg of you. So ratio analysis is one way that we say, you know something, um, we've got to find a way to compare different size companies in the same sort of um, financial grouping, I suppose. What am I looking at here? I'll say financial grouping until the word comes to my mind. Sorry. So when we have banks, we can compare to banks. We have car companies we compare to car companies. We have Walmarts that we can compare to Walmarts and stuff like that. And so we can say, if we have all of the banks that we're looking at, are they all behaving the same way, or are any of them standing out? If they're standing out, are they standing out for the right reason or the wrong reason? If they're standing out for the right reason and they're really cheap, do we buy them? So this is the purpose. This is how we start to sort through stuff. Ratio analysis lets us do this a little bit easier. We can compare and investigate the relationship between different pieces of financial information. Um, if your makeup in your company is 50% debt and 50% equity, and mine happens to be 25% debt and 75% equity, what's that telling us? Do we have to ask the question of why? If we ask the question of why, what kind of answer are we looking for? So this is what we're going to get to. The one thing to remember about ratios, however you start to calculate them, be consistent. You got to be consistent. You can't change things up halfway, or your answers are going to be garbage. So even if you think you're not um, calculating completely correctly how you should be calculating them, continue to do that so you can actually still compare everything. You might not be comparing the exact right answer, but you're going to be comparing the same mistake with every company, which is important. It's more important to get the answer right. But if you're going to have an answer wrong, make sure it's a consistently wrong answer. Um, Normally, when we look at ratios, we're looking at clumps of ratios. Um, and there'll be 3 or 4 ratios in each clump that allow us to look at the same question in different ways. So we look at solvency or liquidity. We look at longer term solvency or leverage. We look at how well we're managing our assets, and that's turnover normally. We look at how profitable are we, and then we'll look at a number of different ways to measure that. And then when we look at valuing our company, what are the financial values or the market values that we use to compare different companies? So we can dig deep into these and say, we're getting 10 companies that have all of these answers. Are any of them standing out for any reason? That's really what we're trying to accomplish here. So short-term solvency or liquidity. Excuse me. Can we pay our bills in the short term? Can we pay our bills without undue stress? What we're usually focusing on now is the very short part of our balance sheet. We're looking at current assets and current liabilities. This is the stuff that's of really interest to short-term creditors, banks that are lending you money particularly. They have a primary requirement to get that money back. There's an old saw in the investment industry that there's 2 things to worry about: the return on your money and the return of your money. Banks want the return of their money. So, We look at solvency and liquidity. Are we able to pay our bills? Are we able to pay our debt as it comes due? Um, Book value and market value, two different things we're going to have to look at as well. I know where we bought this stuff and where we're carrying it on our balance sheet. What's it really worth? And you don't know what it's worth until you actually try to sell it. Um, so for the time being, we're going to continue to look at how we carry stuff in the balance sheet, but we have to, in our minds, say, okay, fine, this is all historic cost. We're not going to know what it's actually worth until we sell it. Now, the problem with short-term assets and liabilities, the current stuff, the value changes very, very quickly. So we have to bear that in mind as well as we're conducting analysis. Not only are we looking at um, what the absolute number is, but what's the pace of change of those numbers. First one is the current ratio. You know this one already. Current assets divided by current liabilities. Um, if you have a number less than 1, you have negative current ratio. That means you have less current assets than current liabilities. It's not a place you want to be. You want a positive number here. There are various transactions that impact this directly, borrowing long term to raise cash. So, say I issue bonds and that provides me cash. The bonds are a long term debt, the cash is a short term asset. When I do that, my current ratio improves, but it doesn't give me the whole story. So we got to be very careful about what goes into these and be aware that when we look at this and say, all right, my current ratio improved dramatically from one um, period to the next. Why? Always ask the question why. I think the most important question in business, well, there's two really: why and so what. As long as you can ask those two questions, get logical answers, you should be in pretty good shape. And the why is, why did the current ratio change from period to period? And in this case, it was we issued bonds to raise cash. Fine. So what? So we have an improved current ratio. We've got great cash, but now our long-term debt has gone up. Now we have to worry about that because that's going to have implications from an interest payment perspective for a long time. The current ratio is improved for a short time. Well, you got to be aware of this. So, for example, if we have $4 in assets and $2 in liabilities, our current ratio is 2 to 1. If we use cash, a dollar, to pay off some short term liabilities, now we've gone from $4 to $3 in assets. We've gone from $2 to $1 in liabilities, and our current ratio has gone from 2 to 1 to 3 to 1. Our current ratio has moved in exactly the right direction. So we're pretty happy with that. But be aware that we've gotten rid of a quarter of our assets, right? Um, think also about what we do to build up assets. If we buy inventory, if we buy inventory, our inventory goes up, our cash goes down, our current assets don't change. So we've really accomplished nothing here. If we sell off inventory or merchandise to pay off short term liabilities, um, then we have to deal with the fact that we're holding inventory at cost, selling it at market. There's going to be a markup involved in there somewhere. The current ratio will rise accordingly because we've created money, we've created cash with the markup. So think about how things are changing and why, and then ask, so what? The current, sorry, the current ratio is good. The problem with the current ratio is not all current assets are the same. What do I mean by that? Well, if you think about current assets, they're going to hold cash equivalents. There's going to be accounts receivable, and there's going to be inventory normally. Cash and cash equivalents are cash. Accounts receivable can be converted into cash relatively quickly if you factor it. You may have to take a small hit, but you can assume 90% of your accounts receivable are going to hold their value. Inventory is a bigger problem. If we could sell inventory, we would have sold it already. So we're holding it for a reason. And we got to make sure that, I mean, you have to have some inventory or you have nothing to sell. If you have nothing to sell and your salesmen go out and make, or salespeople go out and make sales, um, now you got to turn to your client and say, sorry, we don't have that. You got to wait for it to be made. You might get away with that once or twice, but if it becomes a pattern, it's not going to be good. So we hold inventory for that reason. If you hold on too much inventory, though, you're tying up assets, and you're tying up assets at a cost that's going to be different than the market value when you bring it on when you actually end up selling it. But we also have to pay to house those assets. Inventory is not free. It sits in a warehouse. That warehouse has rent, it has heating, it has insurance, it has security. So yeah, we need to have um, inventory, but we don't need to have too much of it. So we got to be careful here. Um, we also want to make sure that what if you have two companies and one has a policy towards holding inventory because they've been burned once or twice because they didn't have anything to sell, and we've got another company that turns out to be marvelously good at turning inventory and doesn't hold any at all. Um, when we compare the current ratios, we're going to get a misleading answer. So what we do instead is we look at the quick ratio and say, we're going to get rid of inventory from this ratio because A, it's hard to get rid of, and B, it's not the same as cash and accounts receivable. So we'll look at the quick ratio is now what's the stuff that we can quickly convert into cash. That would be a cash and cash equivalents and our accounts receivable. And we'll divide that by our current liabilities. Um, as opposed to the current ratio where we expect a value of at least one, we're more than likely or not going to be surprised when our quick ratio has a value less than one. The number itself, be careful here. One of the problems with ratios is the ratio itself means nothing. I can tell you I've got a quick ratio of 1.2. Great. So what? It means nothing to me. I got to compare it against something. So we got to make sure that we're comparing like against like when we do that. And if we go even shorter, I just want to see what my cash looks like. How much cash do I have? I don't even want to look at near cash stuff. I just want cash. This is the stuff that immediately I get rid of. How much of my current liabilities can I pay off? This is definitely going to be the smallest of our ratios. So when we have our current ratio of 1, we have our quick ratio of, say, 0.53, and our cash ratio is going to be even tighter at 0.18. How does 0.18 compare to the 0.53 into the 1.0? It doesn't really. Um, there's no magic number that says I want a cash ratio of 0.25. I want a quick ratio of 0.68. There's no magic number. Um, we are going to see them clumped together by industries, and we want to see outliers in those. And that's really what we're looking for. Um, and some industries are going to be different than others. Some industries hold no cash. Hold no cash. Some everybody holds cash. Some industries hold no inventories. Even in the same industry, some are better at managing inventories. Think about just-in-time inventory systems in cars, invented by Toyota. They're the best in the world at it. They carry almost no inventory. GM is not as good at it because of their spread out manufacturing. And that's a lot of that's political, but it doesn't matter. They do carry inventory, and they carry a totally different amount of inventory than Toyota does. Can we compare those? Yes, but we have to compare those and ask why. So that's important when we look at ratios. Why? And then, so what? So now we have our current ratio, quick ratio, cash ratio, and those look at our liquidity. Liquidity says, what do we have come due now, and can we pay it? And then solvency says, how much debt do we have, and are we going to be in problems paying that? And that includes all the long-term debt and everything else. Um, so solvency measures say the firm has financial obligations that may be long-term. Are we able to meet those obligations? These can also be covered called financial leverage ratios or coverage ratios. And they're normally looking at what is our debt compared to our assets? What is our debt compared to our equity? What's our capital structure look like? Um, I lost my brain here. Sorry about that. I've got a big panting Malamute beside me, and it throws me off sometimes. If you've never seen a Malamute, oh, I can't even get him. There he is. All right. So we're going to look at times debt ratio, times interest earned, and cash coverage. Um, Total debt ratio, total assets minus total equity over total assets. That's a nice way of saying assets equals debt plus equity. Assets minus equity's got to equal debt. It's your debt over total assets. Debt over total assets 0.28 times. I've got 100% assets, 28% debt. Or we could say Proofrock as a company uses 28% debt. Is it good or bad? Once again, these ratios, there's no magic number that says good or bad. We have to look at the number and say, so what? Um, if Proofrock has 28% debt, it's logical to assume that they have 72% equity. Um, they're more beholden to their shareholders than they are to their banks. Uh, Debt to equity is an interesting ratio because it's pretty closely tied to the maturity of the company. And what do I mean by that? A new company. Think all the tech bros coming out with their new companies. Um, how much can they borrow? Not much is the answer because they have no history. Banks are notoriously reluctant to lend to anybody that doesn't have a history of paying it back. Um, it's a trite thing to say, but it's true. Banks only lend money to people that don't need it. If you really need it, they're not going to lend it to you. So, somebody that has a debt to equity of 28% says that they don't really either have access to borrowing or they've switched from or in the process of switching from equity to debt. And the higher the debt component tends to be with companies that have the ability to borrow. If you've been through financial problems, if you've been through financial stress, if the economy's turned south, if we're going to a recession, all of these are going to constrict the amount of money that people are willing to lend to you. So you're going to have to use equity more. And that's what we're starting to see here. So our debt to equity ratio is total debt over total equity. Our total debt ratio is debt over assets. And then our equity multiplier is assets over equity. If you think of uh, the debt ratio is, I'm going to come back to that. I don't want to mess you up here. So we have total debt to total equity, which is our debt to equity ratio, total assets to total equity, which is our equity multiplier, and debt to assets, which is our total debt ratio. Those look at our the long-term section of our balance sheet. What's our capital structure look like? How have we structured the way we want to fund our company? When we go to the shorter part of our balance sheet, we're going to look at times interest earned. If we have to pay interest, how many times can we pay it? So for example, we have $100 in interest coming due this month. Um, how much have we generated through our earnings to be able to cover that $100? Or specifically here, what's our earnings before interest and taxes over how much interest we have to pay? How many times over can we pay that interest? A higher number is good. It's also called the interest coverage ratio. So in our case, we have interest owing of 141. We have EBIT of 600. So our EBIT pays our interest 4.26 times. We're looking for a good number here. The cash coverage ratio is tighter. Once again, we want to get things as tight and squeeze and say, something, if we have to just rely on our cash, how bad's our situation? So what we're going to say is we have EBIT plus depreciation plus amortization. So we throw everything back into the pot. What's left here to cover now? So we have 4.26 times using just EBIT to pay our interest. If we use EBITDA, which is EBIT plus depreciation and amortization, that raises the total from 600 to 876. So now we can cover our short-term interest payment 6.21 times. We're in much better position. Below 1 is very, sorry, I want to go back to that in a second. So it's a basic measure of the firm's ability to generate cash from operations. How much cash we generate from our operations? That's our EBITDA. Can we use this cash flow to meet our short-term financial obligations? Yes, 6.21 times. Fine. What if we compare it to interest-bearing debt? So our interest-bearing debt, if we go back to our balance sheet, interest-bearing debt is notes payable and long-term debt. Whoop, whoop. I should know better than this. Here, 196 plus 457. Let me do it a different way. Our notes payable is 196. Our long-term debt's 457. 196 and 457 is the debt that bears interest that we have to cover. How much is it? You'd think I could have added that together, but it didn't. It's like 600 and like $650 million. We have EBITDA of 876 million. Our interest-bearing debt is 75% of our EBITDA. If we had to, we could pay it off. A number below 1 is strong. You want more EBITDA than interest-bearing debt. If you start to get above 5, where you have 5 times debt over EBITDA, you're going to have a lot of problems going forward. This is where we have to start saying, now we're starting to get, we don't have a number that says this is ideal, but now we have a number that says if you're less than 1, it's pretty strong. If you're more than 5, it's pretty weak. So write that down. This is an important one. So far we've said, what happens with our short-term end of our balance sheet, our current end? What's the current ratio? What's the quick ratio? What's the cash ratio? We're going to get tighter and tighter and tighter. Can we pay our short-term obligations? Then we're going to solvency. We're going to look at our debt now, not our interest, but our debt. Can we cover what we have to? Do we have enough cash to cover the short-term interest payments we have? Yeah, we do. We have 6.21 times. That makes me happy. Out of interest, how much debt do we have that we have to pay interest on compared to what our EBITDA is? And when we look at that, we say, okay, now we've got less debt than we have EBITDA, so I'm a happy person there too. If we have more debt than EBITDA, do we have less than 5 times? Because that gets me squirrely. I don't like to be up there. So those are our measures: times interest earned, cash coverage ratio, and our our ability to cover interest bearing debt. When we look at asset management ratios or turnover ratios, the question now is, fine, I've given you a certain number of assets to run your company with. How effectively do you use those assets to generate sales, to generate receivables, and to generate income? How effectively do you manage your assets? That's why they're called asset management ratios. We're going to look specifically at inventory and receivables and say, are we holding too much inventory, too little inventory? If we have receivables, are we holding too little, too much? How long are we holding this stuff for? If we know how long we're holding it for, how many times a year do we turn it over? These are the questions that we have to ask. Um, if I hold inventory, how long do I hold it for before I can sell it? That's an important question to know. If I have receivables, how long before I collect those receivables? An esoteric question: if my standard policy is when I do sales, my terms are uh, net 60. I want everything paid within 60 days. And then we look at our receivable turnover and it's 75 days. We're nowhere close to what our policy is. Why? What's going on? So let's jump into these. Inventory turnover. Um, what's our cost of goods sold? And then what's our inventory? And how do they compare? I have sales of whatever. What are my sales here? My sales here are where are my sales? Oh, sorry. I have sales of 2.3 million. My cost of goods sold 1.44 million. So I know the relationship between my sales and my cost of goods sold. And I want to be careful on that one. Now, when I look at the inventory I carry, if my cost of goods sold is 1.4 million and I'm carrying inventory of say 400,000, the relationship between my cost of goods sold and my inventory is important. I want to make sure that I'm not holding too much inventory compared to what I'm selling. In this case, I got 1.1435 as my cost of goods sold. Sorry, I should show you the income statement here. 1.435 is the cost of goods sold, and my inventory is 422. So what that tells me is my cost of goods sold covers my inventory 3.4 times. Every year, I'm turning over my inventory 3.4 times. There's not much stale in there. Now, a couple of things. If I know I'm turning it over every 3.4 times, so if I know I'm turning it over 3.4 times a year, and there's 365 days in the year, then 365 divided by 3.4, I'm turning it over every 107 days. Is that good or bad? I don't know. I do know that if I'm a food processor and I'm holding 107 days worth of inventory, I'm shipping rotten food to people. 107 is way too high for food. If I've got cars, cars don't stale. I don't care how long you have to hold a car for. You don't want it into next year's inventory because then you've got last year's model and you can't sell it. But it's going to last longer than food, right? The problem is cars sitting in inventory, you've paid a lot of money for those cars and they're sitting there and you got to fund it. And that's a problem too. So the number of days and the inventory turnover are important, but the number itself doesn't mean that much until you look at the industry you're in and the other companies in the industry and say, how does this compare to everybody else? So we have inventory turnover. We got cost of goods sold divided by inventory. Every 3.4 times a year, I turn everything over. Fine. Um, the higher this number, 3.4, um, the higher it is, means you're more efficient at managing your inventory. All things being equal. Once again, we got to compare cars to cars and groceries to groceries. But in cars to cars, the higher the number, the more efficient you are at managing your inventory. Oh, excuse me. Um, the more often, no, indeed, you want to make sure you're not paying too much for shipments. Is kind of what I'm saying. Um, you want to be able to turn over your inventory, but you don't want to turn it over way too much because if you're turning over way too much, then you're paying way too much to ship it. And you may have a lot of fresh inventory sitting there, but does it have to be that fresh? So we've got 3.4 times a year or 107 days that it sits on your shelves. If we can do this with inventory, we can do this with receivables. When I sell something and somebody owes me money for it, that's a receivable, right? How fast do we collect those receivables? If we have sales, once again, a little back here, we have sales of 2.3 million. We have receivables of 188,000. Our sales are 12.2 times our receivables. That's pretty good. We're turning over our receivables more than 12 times a year. If we're turning them over more than 12 times a year, that means we're holding them for less than a month at a time. Right? I mean, 12 times a year, 12 months at 10. So, yeah, okay. So if we have 12.29 times receivable turnover, and we have 365 days a year, 365 divided by 12.29 is 29.7 days. So every 29.7 days, we've rolled over our receivables. So if we have our terms are net, say 60, and we're turning over everything in under 30 days, we're way within our terms. Do we need to look at tightening our terms? Because we're not using them. Um, or is there something else we have to look at? Our average collection period is how many days it takes us to collect our receivables. Once more, make sure this aligns with collection policy. If you're net 30 and this number is 65, you're not staying within your policy. And either you have to look at the policy to make sure it doesn't make sense, or and right size it, or say there's a problem here. Our clients are not respecting our policies properly. Then we have total asset turnover. Total asset turnover says, I have given you these assets. What sort of sales are you generating from those assets? We have total assets of 3 point, where are we here? Sorry. Go over here. We have total assets of 3.588. We have sales of 2.311. 2.311 over 3 is 0.64 times. What that's telling me, for every dollar in assets we have, I'm doing 64 cents of sales. Is that number good or bad? I don't know. We have to compare it with something to get an answer, but we're using assets to generate sales, and we've got a 64% success rate in doing that. That's one way of looking at this ratio. Then we move into profitability ratios. So we've had um, our short-term solvency and liquidity ratios. So we've got a current ratio, asset test, quick ratio, and cash ratio. And then we go to solvency. Can we pay our interest? And what's our debt structure look like? So we've got our total debt ratio. What's our debt to asset makeup? Debt to equity. How have we chosen to fund ourselves? Have we issued stock or have we borrowed money? Equity multipliers, assets divided by equity. Um, for every dollar of equity, what are our assets? What do they look like? In our case, it's a $1 over 72, et cetera, right? And then times interest earned. We have a certain amount of interest that we have to cover. Can we? If we can, how many times? Then we're going to go a little bit tighter and say, if we can only use cash, what's it look like? Fine. And then we looked at interest-bearing debt over EBITDA. How is our structure looking at here? When we have certain amount of cash or cash equivalents, how does our debt stack up against that? Once again, below one is very strong. If we have less debt than our EBITDA, we're in a happy place. We can cover our debt. We're good. If we start moving the other direction, once we get towards five, be careful because we're getting into a bad area. And then we say, fine, I've given you a certain amount of assets to manage. How are you using those assets to generate sales? And when you make those sales, what do the receivables look like? When you make sales and you're holding inventory, how much inventory are you holding and how fast are you turning it over? So from that, we went to inventory turnover and days sales and inventory, saying, I know we have to hold inventory. Let's not hold too much of it because it's expensive. And then when we do our sales, where some people are going to pay us in receivables, how fast do we get those back? And does that meet our, when we do our asset turnover, um, how are we specifically generating sales using the assets we have um, in the company? Lost my brain there, sorry. That gets us into profitability. So now we know that we're generating sales. In our operations, how efficiently are we using our operations to generate profit? So we're going to have profit margin, EBITDA margin, return on assets, and return on equity. And I'll cover these and then I will stop and have a 10-minute break. So profit margin. Profit margin is pretty simple. What is our net income compared to our sales? Specifically, we have a net income of 363. We have sales of 2.331. Well, I got 363 here. Oh yeah, it's 363 and two. So um, for every dollar in sales, we're generating about 15.7 cents of profit. Or for every dollar, about 15.7% comes back to us in terms of profit. That's not bad. Um, if we want to get a more wholesome approach to how does our operating cash or our operating um, how effective is our operating process at generating sales and generating profits, then we want to look at EBITDA. EBITDA is earnings before interest and taxes, and then we throw back in depreciation and amortization. We don't really have any amortization here, so don't worry about it too much. But so we're going to have EBITDA. And EBITDA is interest before earnings before interest and taxes plus depreciation. And that's $876. We have earnings before earnings, which is EBIT plus depreciation. Go away. So we have 876 over our sales of 2.31. Uh, yes. So that's our EBIT, which is 600, and our depreciation of 276, so 876. Um, we want a high margin here. What's ideal? I don't know, once again. It's comparative, so we have to look at what we're comparing it to. There's going to be a massive variance in industries, but ours happens to be almost 38%. 38% of our sales is used to generate operating income. That's pretty good. If we look on this side, however, there's a massive variance, right? Pharmaceuticals tends to be pretty high at 24.5. Textiles and products tends to be really low at minus 4.6. They don't make money at all. Um, all manufacturing is 13 point, let's say 13.1. And you can see the variance is huge here. When you're comparing ratios, please make sure you're comparing within the same industry. Comparing ratios for cars against banks doesn't make a ton of fundamental sense. All right. Return on assets. You have a certain amount of assets. You're generating income. For every dollar in assets, how much income do you generate? We have assets of 3.588, we already know. We have income of 363. So our net income is 363, and our total assets are 3588. That's about 10%. So we're generating on our assets about 10% return. That matters if we're using a lot of, now I want to retract that. Return on equity says, let's look at the equity. If I'm an investor and I've invested in your company, this is what I particularly care about because I own the equity in your company. How much income are you generating off that equity? So I know you're generating 363, whatever, million, thousand, whatever it is, million, I guess, in income. What's the equity? Well, the equity's 2.59 billion. So for every dollar in equity, I'm generating about 14 cents of net income. Good, bad, or indifferent? I don't know. It depends on everything else in the industry sector. We're using accounting rates of return. However, return on equity is equivalent to return on net worth. It's the same sort of thing, right? I'm going to stop right now for 10 minutes. And then when we come back, we'll race through this and we'll probably finish around 9:15 or so tonight. So let's take a 10-minute break and I'll come back as soon as I can figure out how to stop this. Pause. Alrighty then, we're back. So far we've looked at uh, the short-term asset side of the balance sheet and the income statement that relates to the short-term side of the balance sheet and said, how well can our current assets cover our current liabilities? And then we said, fine, we know we're going to have debt outstanding as well. What's the interest that we owe on that debt? How does that relate to our income? Are we in good shape here or bad shape? And then we said there's a capital structure of our company we'll want to look at. What's our relationship between our assets, our debt, and our equity? And that gave us a bunch of other things to look at. Now we're going to say, how does the market value our firm? Because we get into another area here. And the area is, I know when I look at the balance sheet and income statement, theoretically what my company should be worth. The problem is, it doesn't trade that way. A market value is we are generating income of 363,000. We have assets of 3.588 million. How does that compare? This is what we've earned. What's the earnings make our company worth? Fine. Um, that's earnings per share. And more specifically, our earnings per share is if we have equity of 2.591 million and we have net income of 363,000, how well are we making money based on the investors' money that has been given to us? If we're going to look at it that way, then we'll say, fine. We understand now that this company is earning $363,000 for equity that's worth 2.591 million. That's our returning. That's how much we're returning for our equity. If we have a certain number of shares outstanding, how much are we earning per share? So if there's a billion shares outstanding and I happen to have one share and we've made $1 billion, I am entitled to $1. Yay me. That's my earnings per share. Then we're going to see how the market views that. Do we trade more or less than that? And then different valuations as we go forward. So earnings per share, pretty simple. What's our net income? How many shares do we have outstanding? In our case, whoops, wrong one. In our case, we have 33 million shares outstanding, and our stock is trading at $88. So that's just the given stuff we need to understand. So we have net income of 363 million. We have 33 million shares outstanding. For every share, we're generating $10.99. We are earning $10.99 for every share that we have outstanding. That's our earnings per share. We know that we're trading at $88 a share. So our market value is $88. What's our book value? Our book value of all of our shares happens to be 78 and a half dollars. How do we get there? I'll show you in a minute. But if our market value is $88 and our book value is 78 and a half dollars, our market value to book is 1.12 times. Our market value to book is 1.12 times. Less than one means that we've generated no value for our investors with the shares that have been given. So we're looking for a big number here, not a little number. Price earnings ratio says I know what my earnings per share is. It's $10.99. I know the shares trade at $88. So we're trading $88 over $10.99. We're trading at 8 times earnings. We expect our shares to generate $10.99 earnings a year. The stock's actually trading at $88. So it's actually trading at 8 times what we expect to earn every year. It's called 8 times earnings, or a carry of 8. A number of ways we can refer to this. How much investors are willing to pay per dollar of earnings? Why would you pay more than $1 per dollar of earnings? The only reason is prospects for future growth. I'm willing to pay more than I'm getting in earnings a year because I know I'm going to get future earnings as well. That's the key here. Now, what happens if the firm has no earnings? What happens if earnings per share is 0? Then you're going to have a huge price earnings ratio. And be very careful interpreting that ratio because as earnings per share approaches 0, the number approaches infinity and it becomes worthless. There are industries that trade at very high price earnings ratios. The tech industry is a famous one. Does it belong there? I don't know. There are a lot of stock traders that start to look at excessive price earnings ratios as a one of the reasons they would put a sell signal out on a trade. What is a far extension of that? I would probably look at where has the price earnings ratio traded over the course of the last, say, 10 years, and put a moving average against that, and then look at how we're moving against that moving average. And if we vary too far away from that moving average, then we're getting into oversold or overbought territory. That's how I would probably interpret that. But for the time being, be aware that we're saying, how much is this trading for? $88. How much does it earn a year? $11. Okay, 88 is 8 times 11. So be careful interpreting the ratio, but be aware of where it is because stocks in similar industries should have similar price earnings ratios, unless there's something specific going on with that company. Tesla trades at a phenomenal price earnings. Ford doesn't. Is it rational? No. Um, should Tesla be trading at multiples of Ford? I don't know. Um, I think no. I think it's way overvalued. But I can be wrong way long. I mean, the market can be overvalued for way longer than I have liquidity to go against it. So be careful. It doesn't mean they're going to sell it right now. It just means that there's pressure against it going higher. Market to book ratio. What's the market value of your share? $88. What's the book value per share? We have total equity of $2.591 billion. We have shares outstanding of 33 million shares. Book value per share is 2.591 billion divided by 33 million. Uh, so it's about 78. And if you remember, we went back here, book value per share 78 and a half. That's how we got it there. We said we have total equity of 2.591 billion. We have 33 million shares outstanding. So 2.591 million divided by 33 million gives us $78.50 a share. I know the book value is $78.50. I know that it's trading at $88, so we're trading at a higher than book value. Our market value is higher than book. How much higher? 1.12 times. So that's where market value to book comes from. Um, in this case, we're going to look at total equity, not just common stock. So we're going to include retained earnings because we need to know how much value is in the company that's been generated by stock. And that's not just that's not just our common stock, but it's also the retained earnings and accumulated retained earnings, right? Loosely, what is the market value of investments versus cost? More or less. Less than one means we've created no value for our shareholders. We go from market to book value to enterprise value. Enterprise value says, what's this beast worth? We've got our market capitalization. Um, we've got our market value of interest-bearing debt, and then we've got cash. So what we want to do is we want to say, what's our market capitalization? And that's 2904. What is the market value of interest-bearing debt? Well, we have, whoops, stop. We have notes payable and long-term debt. That's our interest-bearing debt. So we have 196 plus 457. How much cash do we have? We have $98 million in cash. So we have our market capitalization of 2904. We're going to add into our interest-bearing debt of 196 and 457. and then we're taking out our cash, that gives us 3.459 billion in enterprise value. It's closely tied to market capitalization, but we also want to look at more than just stock. We want to look at the debt that we have as well. The market value of stock plus outstanding interest-bearing debt less cash. If we don't know what the market value of this interest-bearing debt is, we can look at book value as proxy, but recognize that it's not quite right. Why are we removing cash? Because if somebody buys the company and it's long cash, we have no knowledge of what they're going to do with cash. They could use it to buy back debt. They could pay a dividend. They could strip it out. They could do anything with that cash. So if we're looking at the market value of a company, get rid of the cash because we don't know what they're going to do with it. And then we look at multiples. Now that we have our enterprise value of 3.459 billion, what's that look like compared to what we're generating? EBITDA, what is the operating cash flow of our company? $875 million. We have an enterprise value of 3.459 billion. We're generating operating income of about 875 million. So our company is worth about 4 times our annual EBITDA. So this is a broad value of the company. It's beyond just stock. And we're forming a multiple now. And you'll notice that industries tend to clump multiples. And when we start looking at buying companies, we need to be able to say, if we know what our EBITDA is, and we know what the enterprise value is, how close do we want to pay to that enterprise value when we bid for the company? Do we have to go over it? If we have to go over it, how much over it do we want to go? If we go under it, we recognize that we're buying something that probably has more value in the parts than in the whole. So we're probably looking at it as a chance to strip the company. That's certainly what a venture capitalist would look at when we're doing this. Are the parts worth more than the whole? And when you start looking at enterprise value, that's going to give you a bit of a clue to that. Companies that have high growth rates tend to have very high EV multiples. Think about tech companies at the startup. Tech companies at the startup are going to have massive EV multiples. So what do we have now? We have our short-term liquidity ratios, which is our current ratio, our quick ratio, and our cash ratio, getting tighter and tighter and tighter. We have long-term solvency or financial leverage ratios. What's our debt structure look like? What's our debt to equity look like? What's our equity multiplier, assets compared to equity? Times interest earned, how well can we cover our interest payments? And then cash coverage ratio, we're going to widen that out a little bit more and say instead of just using our operating cash, operating income, and get a better sense for that. And then we're going to say, fine, now we know what our structure looks like. When we look at how we manage our assets, how do we manage our inventory? How do we manage our receivables? Are we keeping our receivables for too long? Are we holding on to our inventory too long? How many days does it take us to turn this stuff over? And then I've given you a certain number of assets. How do you generate sales off those? How well do you manage your assets? Capital intensity is total assets over sales. And then we get from a profitability perspective, are you able to generate consistent good assets? Profits, sorry. So we have profit margins, net income over sales, return on assets. How are we using our assets to generate income? Return on equity. If I'm a shareholder, how much for every share are you generating income back to me? And then we have different ways to look at return on equity. Return on equity was net income over total equity. But if we rip this apart a little bit, we find out that return on equity is also net income over sales times sales over assets times assets over equity. So specifically what we're looking at, net income over sales is our profit margin. Sales over assets is our total asset turnover. Assets over equity is going to be our equity multiplier. So we can use those three to figure out different ways to derive return on equity, which we're going to do in a minute. And then we have market value. Um, we know what our company's worth. We know what the total equity is worth in our company. We know how many shares we have outstanding, so we can figure this one out. We know what our income is, and we know how many shares we have outstanding, so we can figure that one out. We know what our book value is. We know what our market value is, so we can see what the multiple of market to book is. And then once we have our enterprise value, we can create our enterprise multiple. So we have a bunch of stuff that we've just figured out. But how do we use it? Years ago, when we started down this path of financial statement analysis, DuPont was one of the classic companies they looked at. DuPont has fallen out of favor and whatnot, but the studies that we did of DuPont have led us to a bunch of stuff here. Remember here, return on equity is equivalent to your profit margin times your total asset turnover times your equity multiplier. It's also equal to net income over total equity. So if it's return on assets times the equity multiplier, return on assets being net income over assets times assets over equity. So sometimes we can play games with our what are we looking at here? Oh Lord, I should not do ratios. Sorry. We play games with our ratios. Return on equity is net income over total equity. We know that. If we multiply it by assets over assets, we get an interesting fallout. We get net income over assets, which is a return on assets, and then assets over total equity, which is our equity multiplier. Our equity multiplier is also 1 plus the debt to equity ratio. So return on equity is equal to return on assets times 1 plus the debt to equity ratio. Our debt to equity ratio, I don't even remember where we did it. Sorry. I was way early. I'm not going to look for it. Our debt to equity ratio was, I've got it here. Sorry. It's dumb. Being a dummy here. In the spreadsheet, which I always put together for you guys, I have all the ratios calculated off of their income statement and balance sheet. So you can see how each one of them has been calculated. If you have any questions, please go back to this. It'll explain it, I hope. So what was our debt to equity ratio? Our debt to equity ratio was 0.38. Total debt 997, total equity 2591. 0.38 is our debt to equity ratio. Our debt to equity ratio is 0.38 right here. 1 plus 0.38 is 1.38. Our return on assets was 10.11%. 10.11% plus 1.38 is 13.99, which is our return on equity. What's the difference between ROA and ROE? It depends a lot on the industry, but banks tend to borrow a lot of money. So their debt is going to be significantly larger compared to the equity than some others. Amex has a return on asset of 4.45%. and return on equity of 30, almost 32%. So you can see, depending on the industry, how they use it, debt versus equity really has an impact on how they generate earnings. And it shows you the relationship between ROE and ROA here, where ROE is net income over total equity. We know that. We're making 363 million. We have total equity of whatever we have, 2.591. Which is 13.99%. But it's also, if we multiply by assets over assets, net income over assets, which is our return on assets, which was 10.11%, and assets over total equity, which is our equity multiplier. The equity multiplier is also 1 plus debt to equity ratio. Debt to equity ratio was 0.38, 1.38. So return on assets plus 1 plus the debt to equity ratio is exactly equal to return on equity. This will become useful. Um, what is return on assets? Well, return on assets is net income over assets. What happens if we multiply it by sales over sales? And then we have total assets. What we have then is net income over sales, which is our profit margin, sales over assets, which is our total asset turnover, and assets over equity, which is the equity multiplier. This is what's known as the DuPont identity. Return on equity is defined as the profit margin times your total asset turnover times your equity multiplier. The profit margin being net income over sales, the total asset turnover being sales over assets, and the equity multiplier being assets over total equity. Why is this useful? Well, it's useful because we're going to get into situations where we don't have all the answers. But if we have enough of the components of this equation, we can figure out the rest of the components of the equation. Because the DuPont identity tells us return on equity is profit margin times total asset turnover times equity multiplier. This in turn tells us return on equity is impacted by three things. Operating efficiency, the profit margin. Asset use efficiency, total asset turnover. How well are we using our assets? And then financial leverage. What's the equity multiplier look like? The combination of these three will tell us what's happening to return on equity. So weakness in either operating or asset efficiency, so either the profit margin or the total asset turnover, is going to show up in a weak return on assets and in turn is going to impact return on equity. Return on equity can be leveraged by increasing the amount of debt. It's almost time for the end of allergy season. I'm going to rejoice. ROE can be leveraged by increasing the amount of debt in a firm, but be careful with that because if you increase the amount of debt, this is the so what portion. If you increase the amount of debt, you're going to increase your interest expense. If you increase your interest expense, that lowers your profit margin. If you lower your profit margin, that impacts your return on equity. So we have knock-on impacts that we have to be aware of. If we have a return on equity number that we raise our eyebrows at and say, that seems low, why? We can go back to the DuPont identity and then pull apart the three aspects of it and say, which part of these three aspects of the DuPont identity are impacting return on equity? Is our profit margin low? Are we not using our assets properly? Or is the equity multiplier weird? Do we have something weird with our financial leverage? That gives us a place to start to look. So if we break down the return on equity, we have a better idea of the divergences. When we look at Amazon versus Alibaba, basically the same business, basically the same business. Um, they're obviously run differently. They're obviously different geographically, but um, Alibaba is pretty close to Amazon. Arguably, Amazon has a different quality of product and whatnot, but getting ahead of ourselves here. I have certainly bought stuff off on Alibaba when I ran my small company, and we ran into COVID and we lost our um, supply chain. We had to rebuild it. We had to find our own supply chain. Alibaba turned out to be fantastic for that. I could go straight to the Chinese producers of whatever I needed from a mechanical perspective, and I could fill the gap until we replaced it with our regular suppliers. And in some cases, we just never replaced our regular suppliers. So there's not a problem. But um, when we compare the two, we have to have a look at them, right? Return on equity, Amazon has a substantially higher return on equity. However, Alibaba has a substantially higher profit margin. From a total asset turnover, um, Amazon's is just over one, and Alibaba's is just under, well, just around 52.52. From an equity multiplier, a totally different setup in financial leverage. Alibaba's 1.77 and Amazon's 2.61. So now when we can pull apart the return on equity and say, why is Amazon 15.1 and Alibaba's 10.1? Well, we can see that in the various components, there is a difference in the way they approach life. Um, Alibaba, the advantage is operating efficiency. Amazon is substantially better at asset utilization. And they've got a different debt structure, different financial structure. So now we have different ways of looking at a company rather than just saying return on equity is kind of goofy. So, what is a problem with financial statement analysis? The biggest problem is establishing benchmarks. Um, we know what the ratio is. I don't know what the ratio means. What does a number of 0.53 mean in the greater scheme of things? There's no clear benchmark that says if we have a debt to equity ratio, what should it be? If I'm looking at a current ratio, what should it be? There's nothing really there. We have comparative, but we don't really have the epitome of what we're aiming for. That makes blanket statements very difficult. If I don't know that 5 is the optimal number, then I don't know how 3 compares to the optimal number. When's a good number big? When's a good number small? There's not going to be a real answer here. We're just going to have to figure this out as we go and build up a database of what seems to be effective in this industry. I already said conglomerates are a problem. And I strongly suggest that when we do our assignment, do not pick a conglomerate because they don't fit into any particular industry. Um, their peer group is going to be other conglomerates. If you look at, I don't know, Westinghouse, General Electric, um, you'd think they're electric companies. They're not. So be very, very careful. They do a bunch of other stuff too. Globality is a problem. When we look at HSBC's balance sheet, Hong Kong Shanghai Banking Corporation, um, dual headquartered out of Shanghai and out of London. Um, do they use GAAP? On some of their balance sheets, sure. On all of them, not necessarily. Um, what about currencies? How are we going to figure out what currencies we're dealing with? HSBC has 100 that they have to figure out. RBC has half a dozen or so. The big American banks tend to work in US dollars, so that's a little bit easier. But matching financial statements is difficult. And then what about regulated monopolies? Canada, we have them. Um, we don't like to think of banks as a regulated monopoly, but they are kind of an oligopoly. There's only about a half a dozen of them. They tend to do things pretty much the same way. What about electric companies? They're regulated. They could be monopolies. Um, they're going to have different procedures for inventory. Banks don't all have the same fiscal year. Canadian banks end on October 31st, US banks end December 31st. How do we compare fiscal years now? Particularly when we have different economic cycles um, working through those different years. We could have something happen in the last 3 months of the year that's not going to be picked up on Canadian banks' financial statements because they're ended and it'll be next year. But it's still this year for Americans. So that's a problem. And we have to figure out what do we do with one-time events. We sold a division. We got sued. Uh, we won a lawsuit. These are all going to have impacts on our net income. They're going to screw up our statistics and they're going to screw up our ratios, but we got to figure out how to strip that out so we don't continue to use those numbers against everything else. Um, the other good use of financial statements is looking forward. Looking forward requires some art because looking backwards is easy. That's what financial statements do. The balance sheet says, as of this period of time, this is where the picture is. The financial statements, the financials, the income statement says, between these two periods, this is what happened. How do we use that going forward, though? How do we create pro formas or best guess estimates of what's going to happen? We know what our current situation is, but now we have to try to set some sort of planning going forward. Are we doing this from a personal perspective or from a business perspective? From a personal perspective, we want to know what our income, expenses, savings, etc. are, so we can set up life goals. To do that, we need to know where we stand now. We need to know where we want to get to. And then we need to put steps in place to get there. From a corporate perspective, it's not substantially different. We got to know where we stand right now. Because if I don't know where I am, I can't tell you how I'm going to get to where I want to go. So we need to very clearly define where are we. Then we need to clearly define what does our target look like. And then we have to say, so what? How is this going to change things? So a simple model. We have a very, my spelling is atrocious and my typing is horrible. So I do apologize for spelling issues. Our current income statement, we have sales of 1,000, costs of 800, net income of 200, assets of 500, and debt to equity of 250, 250. Relatively straightforward. Now we have to make an assumption about the relationships that we have in our financial statements. Generally speaking, when we say, what are we targeting in terms of performance? It's going to be either net income or it's going to be sales or something like that. Right now, we're going to concentrate on sales. Our goal is to grow sales by 20%. So what? What's that mean? If sales go up by 20%, do our costs compared to sales remain constant? If that's true, then our net income should remain constant too as a percentage. But as we're growing our sales, how does this impact our balance sheet? Our assets, um, as we sell, we're going to pick up cash and accounts receivable, so they're going to go up. Are they going to go up at the same pace as sales? How are we funding that? Are we borrowing money to do it? Or are we leaving our debts constant. As we generate net income, what are we doing with that net income? Are we paying it out in dividends? Are we plowing it back into the company? If we plow it back into the company and our sales go up, and that puts our net income up, then the amount that we plow back into our company goes up too, and that has to be added onto equity. So we have a whole bunch of stuff that happens. But the easiest assumption and the simplest place that everybody starts, if sales grow by 20%, everything grows by 20%. So sales go from 1,000 to 1,200. Costs go from 800 plus 20%, which is 16, to 960. 1,200 minus 960 is 240. 200 plus 20% is 240. Okay, we're good here. Assets plus 20%, 500 plus 20% is 600. Okay, we're good so far. We know debt and equity have to equal 600. 250 plus 20% is 300, and 300 is 600. So we're good. As long as everything grows at the same pace, the simple is good. However, the simple is not really realistic. It's a good place to start so we get used to doing this sort of things. And just for your good, as I said, I have done this. It is, where did I do it? Here. 1,000, we grow everything by 20%. So everything grows by 20%, plus 20%, plus 20%, et cetera, et cetera, et cetera. It's not really realistic. Things don't all grow at the same speed. We know that. So, what do we know? What happens if net income increases by $240 and equity only increases by 50? Where'd the rest of the equity go? We had 240. If we only added 50 of that 240 onto our equity, where's the rest? We must have paid it out in dividends, right? Specifically, retained earnings should have been 240. They're only 50. So we should have paid out 190 more. Sorry, we should have paid out 190 in dividends. Sorry. What happens if we don't pay out the 190 in dividends? If we don't pay out the 190 in dividends, then we have to do some changes over here. Specifically, we know that our assets are going to be 600. We know that our equity is going to be 300 plus 190, so 490. If assets equals equity plus debt, then our debt had to have been paid down to 110. We have to continue to keep our relationships constant. So make sure everything makes sense. If we increase sales and increase our net income, think about what happens to that net income. Either it gets paid out in dividends or we hang on to it. If it doesn't get paid out in dividends, where's the rest of it? We got to be able to answer that question. That leads us to the next step. And the next step is there's probably a better way of looking at this. If we change sales by 20%, what else changes? And that's what we have to ask the question. And if it's not given to you, then you're going to have to make some assumptions. But generally speaking, the questions are going to be said, if you increase sales by 20%, assets increase by 20%, or current assets increase by 20%, debt does not change. Equity does change. Or debt and equity doesn't change. What else changes? So we're going to have to see what happens. Specifically, we need to separate our financial statements into what's driven by sales and what's not driven by sales. If we see a forecast that says sales have to go up by 20%, we got to figure out what else is driven by sales and make sure that goes up by 20% too. If it's not driven by sales, we got to leave them alone and figure out where the plugs are elsewhere. This is called the percent of sales approach. So when we look at a financial statement, what have we got? Rosen Corporation. Where are we here? Rosen Corporation. That's Hoffman. Rosengarten. Here we are. Is that the same company? Oh, it is the same company. All right. So we have sales that go from 1,000 to 1250. Our costs are going to keep this relationship. What is the percentage of sales of costs to sales? And it's 83%. If it's 83% here, it has to be 83% here too. So I want to make sure that if sales go up from 1,000 to 1250, costs go up by the same percentage move. The percentage of cost to sales remains constant at 83.3%. So 83.3% of 1250 is 1040. That gives me my taxable income. Tax rate's 21%. That's fine. Net income, that's fine. I know that. So it's going to be taxable income less taxes, net income. Dividends. We generated 132 something, say $132 in net income. Of that, a third went to dividends and 2/3 were plowed back into retained earnings. When we increase sales and we increase the net income from 132 to 165, the breakdown of dividends to retained earnings are kept constant. The percentage is constant. If it's a third and 2/3, it's still a third and 2/3. So we have 55 to 110. This is going to help us when we build our balance sheet going forward. Now then, we want to say of sales of 1,000, how does our balance sheet stack up against sales? Well, cash of 160 is 16% of sales. Accounts receivable of 440 is 44% of sales. Inventory is 60% of sales, which gives total current assets of 120% of sales. Then we have fixed assets, 1,800, which is 180%, and total assets of 300%. So our total assets are 300% of sales. When we increase sales to 1,250, our total assets should still be 300% of sales. In fact, whatever these percentages are, remain the same, and we change the assets accordingly. If our new sales are 1,250 and our cash is 16% of that, that's 200. If our accounts receivable are 44%, that's 550. So we're keeping things constant. From a liabilities and equity perspective, we're told that the only thing that remains constant is accounts payable. Accounts payable will always be 30% of sales. So we know that 3,750 is what our total assets are going to be. Total assets and total liabilities should be 3,750. Our accounts payable are going to be 30% of 1,250, which is 375. Notes payable don't change, so that's 100. It's a total of 475. Long-term debt doesn't change, which is 800. Common stock doesn't change, which is 800. Retained earnings with 1,000, but with our new net income, we have our new plowback, which is our dividend minus, sort of one minus a dividend. And that gets added onto our retained earnings. So 110 gets added onto 1,000, which is 1110. That gives us our total equity of 1910. Our total debt to equity is 3185. It should have been 3750. It's 3185. We're short money. Specifically, we're short $565. This is external funding needed. And we're going to come back to that in a half a second here. So remember the rules. Sales increased by 25%. Net income of 132 compared to 1,000 is 13.2%. Net income after sales growth should also be 13.2%, which is 157. That 157 is going to be broken down into 1/3 we pay out for dividends, 2/3 we plow back into the company. And we have to keep this constant. So what happens there? We know our current liabilities are going to change, right? Current liabilities are going to change with sales. We also know what our breakdown here is because I just went through it. When we increase our sales, we have to increase our balance sheet component to match the same percentage breakdown in the asset side as existed before. So we'll do that. And that gives us a total assets of 3750. As I said, accounts payable is the only thing that moves with sales. So accounts payable was at 300. It was 30% of 1,000. We want 30% of 1250, which is 375. None of the other debt pieces change. So 100 stays the same. Total is now 375 plus 100. Long-term debt still 800. Common stock is still 800. Retained earnings, we had 1,000. Why is this 104? Well, here, right here. Oh, well, that's 104. Should be 55 and 110. 110 gets added on to the 1,000 to give us a retained earnings of 1110. So we have total equity of common shares in surplus of 800 plus the retained earnings of 1910. That gives us a shortfall. And that's where we're at here. And the shortfall 565. Is that this is the external financing that we're going to require in order to make sure that our total liabilities and equity balance with our total assets. We got to borrow money. So we're going to have to change our debt, right? So now we'll work backwards. I showed you how to do it longhand. There's a shorthand way of doing it too, which is good. External funding required. Assets over sales times change in sales. Spontaneous liability over sales times change in sales. Profit margin times the new projected sales. So we had 1275. Our profit margin was 13 point whatever percent. And then how much are we plowing back? What's 1 minus the dividend rate? Change of sales is the change in dollars, obviously. We went from 1,000 to 12.7 to 12. Oh, Lord. We went from 1,000 to 1250, which is a change in 250. Our profit margin is 13.2%. Our dividend payout is 1/3, or 33%. If we pay out 1/3, it means we plow back 2/3 into the company, 1 minus the dividend, which is right here. So what do we have? Assets over sales. We have $3,000 in assets over $1,000 in sales. Times the change in sales, which is $250. Fine. Spontaneous liabilities. What are spontaneous liabilities? The liabilities that move up and down with sales. In our case, it's accounts payable. Accounts payable was 300 over 1,000. So 300 was our accounts payable, 1,000 was our sales. And we're increasing sales by 250. Fine, so that's that piece. Our profit margin is 13.2%, and we're increasing sales by 1,250. Fine. Um, and how much of that do we plow back into the company? 66%. Projected sales increase, spontaneous increase in liabilities, and profit margin, and projected sales multiplied by retention ratio. How much are we going to have to borrow? If we increase our sales by 250, then the asset sales component um, is going to give us a certain amount of asset growth. Then we're going to have a small growth in liabilities, and we're going to have projected profit off of those new sales that we're going to plow back into the company. The difference between all of that gives us $565, which is the shortage that we're going to have to fund. That's exactly the number that we came up with on our long-headed calculation. Um, or or external funding needed, assets over sales times the change in sales, we saw that. Spontaneous liability over sales times the change in sales. Profit margin times projected sales times the plowback rate. Our change in sales is $250. Our spontaneous liabilities is 300. Our profit margin is 13.2% from right here. I'd probably make that bigger, but I don't have to. And our dividend payout is 33.3%. Give me half a second here. So what do we have? $750 is our asset over sales times the change in sales. Spontaneous liabilities times the change in sales is 30%. Sales times spontaneous liabilities divided by sales is 75. Profit margin times sales times retention ratio is 165. Add those three together, 750 minus 75 minus 166 is 565. All righty. We can see now external funding required and growth are very closely related. How do we grow? And how much of that growth do we have to fund? Do we fund it internally or do we not fund it internally? If we can't fund it internally, do we have to borrow it? Yes, now we know. Everything else being equal, the higher the rate of growth in sales or assets, the greater is going to be the requirement for external funding. The faster you grow, the less you can fund internally. What if we look at the relationship between financial policy and the ability to finance new investments and growth? What's that mean? We have set up our debt structure. Do we want to keep it in place? Are we allowed to play with our debt structure? If we're not allowed to play with the debt structure, what do we have to do? Growth is a convenient means to see the interaction between investment and financing decisions. How much do you want to grow? How much do you want to finance? If you don't want to finance, it's going to limit how much you can grow. What's the relationship between external financing and growth? We have our Hoffman Company pro forma financial statements here. Sales 500, cost of goods sold 417, which is 83.3% of sales. Taxable income is the difference. Taxes at 21.4%. Gives us net income of 66. That 66 is the third dividend and 2/3 plowback. Our assets are 200 current assets, 500 fixed assets, total assets of 500. How does this relate to sales? 200 is 40% of sales, 300 is 60% of sales. Okay. Total debt. 250. Owner's equity, 250. Debt to equity is 100% because debt equals equity for a total of 500. Our return on equity is 66 over 250, or 26.4%. Now then, let's assume sales grow by 600, go to $600. If we go from $500 to $600, we've grown by $100. $100 is 20% of $500. So we're either growing by $100 or 20%, however you want to look at it. What's this mean? Well, our sales go to 600. Our costs remain at 83.3%. That gives us a taxable income of, whoops, gives us a taxable income of just over 100. Tax rate of 21.4%. Why are you 21.4 instead of 21? Well, it doesn't matter. Net income of 79.2. What did that change if we go to 21.4? Not dramatically. Okay. We'll keep the same 1/3, 2/3, and that gives us new dividends and new plowback. What else changes? Well, current assets are going to change with with sales. Sales increase by 20%. Current assets are 40% of that. So 40% of 600 is 240. 60% of 600 is 360. And 60%, 600 of 600 is 100%. Our total debt is not going to change. Have I put that in here somewhere? Debt to equity of 1. All right. Assume a $100 increase, 20% increase. Costs remain at 83.3%. No debt numbers change, but owner's equity increases by retained earnings. Owner's equity increases by retained earnings. Okay, so 250 remains unchanged. 250 plus 52.8 or 52.77 is going to give us 302.77. Total assets is 600. Total debt and new owner's equity is 552.72. The difference between these two says we're going to have to finance 47.2. So our new debt is going to be 47 is 250 plus our 47.2 is after we do our financing. A couple of things. We had a debt to equity of 1-to-1, 250 debt, 250 equity. Now we have a debt equity of 98.2%. Debt didn't change at 250, but our equity went up to 302.77. In turn, our debt to equity dropped to 98.2. This is a relationship that is going to hold, and it's going to have a pattern to it. Specifically, projected sales growth and the impact on our debt to equity ratio is predictable. And there is a point where our projected sales is going to result in external financing required dropping to 0, and then it's actually going to start paying for itself. This point is of a lot of interest to us. That's the point where we no longer need financing to grow. Where are we going to get there? That is the internal growth rate of the firm. There's a direct link between growth and external finance, and we know that now. We've seen it. We can only grow so much without requiring more financing. The first growth of interest is the maximum rate that we can grow without external financing. When we hit the wall, that's where we can no longer grow without borrowing money. This is the internal growth rate. That's right here. The required increase in assets equals the addition to retained earnings. The internal growth rate is also the return on assets times the plowback. So the plowback is 1 minus the dividend rate over 1 minus the return on assets times the plowback. For Hoffman, the net income was 66 and the assets were 500. 66. 66 and the assets were 500. Internal growth rate was return on assets, which is 66 over 500, times the plowback rate, which is 1 minus 33, or 0.6666, whatever. Where do we have return on assets? I calculated here. 66 over 500 is 0.132. So 0.132 times 0.66 divided by 1 minus 0.132 times 166 is 9.64%. The internal growth rate of this company without external financing is a maximum of 9.64%, which falls kind of like right here, right? So that's the internal growth rate. There's also something called the sustainable growth rate. And that is, where can we grow without more equity financing? So where can we grow by borrowing money but not equity financing? We want to continue to keep our debt to equity ratio the same. We want our financial structure to be consistent. So we don't want to dilute ownership. We want to figure out what our sustainable growth rate is. And in that case, we're going to switch from return on assets to return on equity. And we're going to ask the same sort of question we asked with assets. Return on equity times the plowback rate over 1 minus return on equity times the plowback rate. Net income over total equity was 26.4%, so that's a return on equity. Return on equity is 0.264 times 0.6667, that's 1 minus 0.333, over 1 minus that, equal 21.35, or 21.35%. We can grow at 21.35% without impacting our capital structure, without having to tap the equity markets more. What does that look like? Here. Pro forma at 21.35% growth. At 21.35% growth. We had sales of 500. If we grow at 21.35%, we go to 606.2. Let's adjust everything down accordingly by the percentages we know we have. So we have 83.3% for costs, gives us our taxable income. Our tax rate's 21%, gives us our net income. From that, we can split out 1/3, 2/3. Our assets are going to be 40 and 60% of sales. So we have our assets fine, and we have 606.8 is our total assets. Debt doesn't change. We know equity is going to be 250 plus 53.4. So 303.4. 250 plus 303.4 gives us 553.4. Compare 553.4 to 606.8, and we have financing required of 53.4 million. Blah, blah, blah. The 53.4 million, when we add it on to our total debt, gives us the same debt to equity as we had before. All righty. So when we pull apart this DuPont identity, and it lets us decompose the return on equity into profit margin, um, which is the increased ability to generate funds internally and increase sustainable growth. Dividend policy, how much are we paying out and how much are we keeping? What are we keeping? We're pulling it back into the company for future growth. Financing policy, do we have to keep our debt to equity ratio constant? If we have to keep our debt to equity ratio constant, how fast can we grow? And then total asset turnover. This increases the sales generated for each dollar in assets, and it decreases the need for new assets as sales grow. When we hit sustainable growth, we have to stop adding stuff. So this is the same as increasing capital intensity. So let's look at a company. We have Sandar Company. Debt to equity ratio is 0.5. Profit margin is 3%. Dividend payouts 40%. Capital intensity ratio is 1.0. What's the sustainable growth? And what if we want a 10% growth? Okay, so what is sustainable growth? Excuse me. Oh, we have a bunch of stuff. What we do not have is numbers. Specifically, we can't play this game here. So we're going to have to use our equation. Return on equity is the profit margin times the asset turnover times the equity multiplier. What's the profit margin? Our profit margin is 3%, so 0.03. What's the asset turnover? Our capital intensity ratio is our asset turnover. It's 1. And what's the equity multiplier? The debt to equity ratio is a half. So that means that we have half the debt that we have equity. So if we have 50 debt, we have 100 equity. If we have 50 debt and 100 equity, then we have assets of 150 because assets equal equity plus debt. If we have assets of 150 and equity of 100, then we have a multiplier of 1.5. So now we have our equity multiplier of 1.5. So we have our profit margin plus our asset turnover plus our equity multiplier is 4.5%. Our return on equity is 4.5%. Fine. That gets us closer to what we need. All right. What is our sustainable growth rate? Sustainable growth rate is the return on equity times our plowback rate over 1 minus return on equity plus plowback rate. Return on equity was 4.5%. The plowback rate is 1 minus 40% or 0.6%. 0.6 times the plowback rate is so 4.5% times 60% is 2.7%. 1 minus 2.7%, which trickily this is 0.973. 0.027 divided by 0.973, 2.77% is our sustainable growth rate. Okay, that's question number 1. Question number 2. What if we wanted a 10% growth rate? If we want a 10% growth rate, we have growth equals to the profit margin times the multiplier times the plowback rate divided by 1 times the profit margin times the plowback and the equity multiplier. Blah, 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 long-winded way, 10.1%. If we want a growth rate of 10.1%, then our return on equity has to be 10%, 10.1%. All right. 2.77. Our profit margin has to increase from 3% to 10.1% if we want a 10% growth. So profit margin equals to 0.1 divided by 0.99 is 10.1%. All righty. So we have our summaries of internal growth rates and sustainable growth rates. Internal growth rate, how much can we grow off our return of assets? And sustainable growth rate, how much can we grow without changing our capital structure? So we want to keep our debt to equity constant. That's our sustainable growth rate. Internal growth rate, how fast can we grow without external financing? So now we have some caveats. Remember to ask the right questions. You're given a set of financial statements. There's a whole heap of so what in those financial statements. You got to pull out what you need. Use financial relationships instead of accounting relationships. Remember, now we're no longer dabbling in accounting. Now we're looking at financing. Financing needs cash. We need cash flow size. We need the risk of the cash flow and the timing of the cash flow. Some of the models that we're using are really going to help us increase value. They're going to divert your attention to asking other questions. What's the debt to equity ratio? What's the growth look like? Blah, blah, blah. Remember to ask the right questions. Most models we have just generate pro forma statements. We want to get past that and read what those pro forma statements mean. The financial planning process is an iterative process. Try 10%, try 15%, try 20%, try 25%. Let's see what happens. There's something called the Procrustes approach, which drove me crazy on all my time working in the industry. Senior leadership comes to you and says, I want to grow net income by 10%, make it happen. Now you got to work backwards and figure out everything that has to change to make that 10% work. That's not really the way this is supposed to happen. But it gives you an idea of where you may end up. And that's all I've got for today, ladies and gentlemen. Have a very good evening and a very good weekend. I have taken the liberty of answering a lot of the questions on here. So questions 1 through 10 are answered in this tab. 11 through 13 are answered in this tab, and then I ran out of time. I have also put all of the answers to all of the questions on Blackboard. Make sure you're running through these exercises. I can't stress this enough. Repetition is your friend. I know it's crazy making. I know it takes a lot of time. I know it's a lot of work, but it's your friend. So we have the quiz. Don't forget to do the quiz, please. Oh Lord. Did I ever restart this? I think it did. Oh, come on, you. Oh, I did. Okay, good. Repetition is your friend. Please do as much as you can. We have the quiz. Don't forget to take the quiz, please. Um, After midnight tomorrow, you can still take the quiz, but you're going to lose 10% a day. Don't do that. It's not worth it. Just take the quiz. I will put together your document on the assignment and get it to you next week. And once again, start thinking about the companies you want to look at, and spend some time to make sure that it's a challenging company, but not too challenging, because you want to do yourself a favor on this one. So try to avoid conglomerates, try to avoid companies that are too complicated. Pick 1, 2, or 3 and then have a look through them and say, okay, this is one that I'm kind of comfortable with. And that's all I got. Any questions? Okay, ladies and gentlemen, have a great weekend, and I will talk to you all next week. If there's any questions, email me, please. I'm muted. Oh no. Oh, I hope it wasn't muted all this time. If I was muted all this time, I will retape this. Um,
You know, good. Thank you.
I will retape this and I'll get it out to you as soon as I can. Thank you very much, everybody. Have a good evening.